Hello and welcome back to StockSynops. I'm your host, bringing you bite-sized lessons on the world of investing. In just 5 minutes, we'll break down key concepts to help you build your financial knowledge quickly and confidently. If you're just joining us, go back and watch video number 1 on the basics of investing and video number 2 on stocks, bonds, and markets. They set the perfect foundation. Today, we're stepping deeper, how the stock market actually works, buying, selling, and what drives prices. Let's jump right in. Picture the stock market like a massive online auction happening every weekday, all day long. Millions of people, from big institutions to everyday investors like you, are constantly bidding to buy or offering to sell shares of companies. The price of a stock, it's simply the last price someone agreed to pay in that ongoing auction. When more people want to buy a stock than sell it, demand is high, so the price goes up. When more want to sell than buy, supply is high, price goes down. That's the core of supply and demand, the heartbeat of every market. Who's doing the buying and selling? You place orders through a broker, like the beginner apps we mentioned, Fidelity, Robinhood, Charles Schwab, and others. You can buy whole shares, or even fractional shares, meaning you can invest $50 in a stock that costs hundreds per share. Most trades are electronic now, super fast, and commission-free on many platforms, so no big fees eating your returns. Key players behind the scenes: individual investors like us, trading from phones or computers, institutional investors, big funds, pension plans, hedge funds, moving huge amounts. Market makers, firms that help keep trading smooth by always being ready to buy or sell. Exchanges like the NYSE or NASDAQ, where the actual matching happens. Prices don't move randomly. They react to news, company earnings reports, economic data, interest rate changes, global events, even investor emotions like fear or excitement. For example, if a company beats profit expectations, more buyers jump in. Price rises. If bad news hits, like a product recall, sellers dominate. Price drops. Indexes give the big picture. The S&P 500 tracks 500 large U.S. companies, often called the market. When people say the stock market is up today, they usually mean indexes like this are rising. Historically, over long periods, despite ups and downs, the market trends upward. The S&P 500 has averaged around 10% annually, including dividends, or about 7 to 10% after inflation, rewarding patient investors who stay in for years, not days. But short-term, it's unpredictable. Prices can swing wildly. That's why we don't try to time the market. We focus on time in the market. Buying process in simple steps. 1. Open a brokerage account. Fund it. 2. Search for a stock or fund ticker, like AAPL for Apple. 3. Decide how much to buy. Place a market order or limit order for a specific price. 4. Hit confirm. Done. Selling is the reverse. When you want cash or to lock in gains, remember, you only realize a loss or gain when you actually sell. Until then, it's just paper changes. This is the mechanics. Next video we'll talk risk and reward, why prices swing, and how to think about them as a beginner. To wrap up today, the stock market is an auction driven by supply and demand. Buy low, sell high is the dream. But smart investing means focusing on quality assets, patience, and not reacting to every price wiggle. Prices reflect news, earnings, and sentiment. But long-term, growth wins for those who stay invested. Please remember, this video is for educational purposes only and does not constitute financial advice. Investing involves risks, including the potential loss of principal. Always do your own research or consult a qualified financial advisor before making any investment decisions. Past performance is not indicative of future results. If this helped you picture how the market really operates, give it a like. Subscribe for the full beginner series, and comment, have you ever placed your first trade? Or are you gearing up to? See you next time when we cover risk and reward, the fundamentals every investor needs. Thanks for watching StockSynops.